Good afternoon and welcome to this webinar, which is called Our Guide to Putting Assets into Trust. My name's Kerry Parsons. I'm a senior solicitor here at Harrington Carmichael, and this is my colleague Alex Strickland, who is a solicitor. We both work within the private wealth and inheritance team. Just a little bit about Harrington Carmichael before we get into the webinar itself. So Harrington Carmichael is a full service law firm with over 180 staff members now. We are predominantly based in Farnborough, but we also have offices in Ascot, Reading, and some space in London to meet clients. We do class ourselves as relationship lawyers. So for us, we pride ourselves on looking after our clients and retaining our clients in the long term, and just providing that level of service so that clients do want to come back and see us again and again for any legal issues they may have. On this slide here, we've just given a brief overview of the services we can provide. So predominantly we support businesses with all sorts of different legal issues, and you've got a list there of the main areas we can advise on, and then we also support individuals on various different matters to include private wealth and inheritance, which is the area we work in, family law, property and so forth. All of this information is contained on our website. We are part of IR Global, which is an international network which provides us with a network of other lawyers all around the world. So if you do have legal issues in another jurisdiction, then we can help with that. Or if you have a legal issue with a cross-border aspect, again, we can help and work with other lawyers in relation to that. So onto the webinar itself, today we're obviously looking at trusts and our guide to putting assets into trust. We are going to look at what specifically a trust is, when trusts are actually used, the different types of trusts that we work with on a regular basis, trusts used within wills, trusts which are used generally in lifetime. And then we'll also look at a few real life examples of when trusts may be of use.
So what is a trust? So a trust, put simply, is a mechanism for managing assets. So one person or two people can transfer assets to the hands of trustees, which can be individuals or a trust corporation. And that can be money, investments, land and buildings. And the trustees would hold those assets for the benefit of the beneficiaries, who can also be individuals or charities. There are many different types of trusts, and they all have their own sets of rules in terms of how they work and how they are taxed for inheritance tax, capital gains, and income tax. So trusts are generally used either in a will, so they come into effect on your death, and these are for asset protection, to create some control, such as, for instance, if you've got family members who may be struggling with addiction or gambling problems, or maybe going through a messy divorce, you can control that, and it gives you a bit more flexibility. And you may also be able to put age contingencies in there as well, as to when you want certain beneficiaries to inherit something. They can also be used during lifetime, usually for tax planning and asset protection. So we've got 6 key trusts that we use. So these are Bare Trusts, Bereavement Minors Trust, 18 to 25 Trust, Vulnerable Persons Trust, Life Interest Trust, or Interest in Possession Trust, and Discretionary Trusts.
So trusts within wills, we're just going to take a look at those first. And here I've just put onto the slide a few different reasons why you might want to use a trust in your will. So the first one there is if you're particularly wealthy. So often if clients come in and see us and they're really wealthy, they might say to us that they don't want their children to inherit a large sum of money in one go. They want them to make their own way in life rather than to rely on the inheritance that they're getting. So they may also say that due to the amount of wealth that they have, that they may want future generations to inherit. So by using a trust, we can facilitate their wishes so that funds can be drip fed to the children or kept back for future generations. Also, people that have circumstances which are changeable. So if your circumstances are constantly changing, then you might want to use a trust to, again, offer a bit more flexibility. If you're a blended family, so what we mean by that is perhaps you were in a relationship with someone married, or you may have been common law partners. You may have had children together, and then your relationship's broken down. You then go on and you meet somebody else who's also got children from their previous relationship or a previous relationship. So that's what we mean by a blended family. So in that situation, you know, it might be that you want to provide for one another as partners, or if you've got married, for each other as spouses, but you may want to ensure that each of your individual children inherit from your estate, without the risk of the survivor of you basically writing out the one who's died, you know, the children of the person that's died first. Concerns regarding care fees, obviously care fees are going up massively, or they have done over the years. You know, probably the average, you know, weekly care costs down this part of the country, you know, can be sort of £1,500 per week or more. So often individuals are concerned that if they pass away, that if everything passes to, say, surviving spouse and they go into care, that all of the assets will be used up in care fees and there'll be nothing left to pass on to future generations or whoever they would wish to benefit from their estate. So we could use a trust there. Concerns with young children, grandchildren inheriting. You know, many people are happy for children to inherit or grandchildren to inherit at 18, and that's perfectly fine. But others feel that that is too young and may want to put in a slightly higher age contingency, so we can use a trust for that. And also, as Alex briefly mentioned in the previous slide, about beneficiaries who may be going through some difficulty. So say one of your children, for example, was going through a divorce, or you had a child that's maybe in a difficult relationship, suffering from perhaps alcoholism or a drug addiction, whatever it might be. By using a trust, we can control how that money is distributed to them. So bare trusts, what is a bare trust? So essentially in many wills, lots of clients turn around and say that they're very happy for their children to inherit or grandchildren to inherit at 18. They feel that that's a suitable age, and that's absolutely fine. Now, normally in those circumstances, we wouldn't generally put in an age contingency. It would just be left blank. What that means is they do inherit absolutely when they pass away, but if they are under the age of 18, they are still considered a minor. So at that point, what happens is the trustees, who are more often than not the executors appointed in the will, but don't have to be, will hold the funds or assets, whatever they might be, for those children or grandchildren until they reach the age of 18. They can advance money for their education and maintenance. But once they're 18, they are able to go to the trustees and essentially say, I want my money, or I want those assets. Trusts called bereaved minor trusts or 18 to 25 trusts. So these can only be created where you leave assets to a child in your will. A bereaved minor trust, so if you did put in an age contingency of 18, meaning they have to hit 18 in order to inherit, this would be classed as a bereaved minor trust if you die when your child is still under the age of 18. Whereas an 18 to 25 trust would come into effect if you put in an age contingency between that age bracket of 18 to 25. So if you put in the age 25, then it would be deemed to be an 18 to 25 trust. Again, when the minor is below the age specified, funds can be advanced for their education and maintenance. But But the good thing about these types of trusts is they do have some inheritance tax advantages over some of the other trusts, in particular discretionary trusts, which we'll come onto. We're not proposing in this webinar to go through all the different taxation because that's quite complex and is probably a webinar in itself. But it is advantageous when these particular two types of trusts are created from an inheritance tax perspective post-death.
So another type of trust we have is the vulnerable persons trust. And these trusts are, as the clue is in the name, for vulnerable or disabled people. So you would need to satisfy a certain criteria. So you need to have a recognizable disability and be in receipt of some benefits such as adult disability payment, attendance allowance, child disability payment, etc. There's quite a long list here on the slide. Essentially how this trust works is that it's discretionary in nature, but you would usually just have that one. If you have multiple children who have disabilities, then they would be the principal beneficiaries of this trust. That's not to say that you can't have other beneficiaries as well, such as other children of yours or people who are assisting your disabled child or grandchild or whatever it is. And they can have the lower of 3% of the trust fund or £3,000 per annum, just as a sort of a distribution to them. And ultimately, when the disabled person dies, then the trust itself becomes an ordinary discretionary trust and other beneficiaries can inherit at that point. The point of this trust is that it does enable their benefits to be protected. They're not receiving huge amounts that go against their the benefits allowance. So like you sort of have a threshold about how much you can actually have in your bank account before you start reducing benefits, and has advantageous tax treatment as well. The vulnerable person can elect to have vulnerable person treatment for income tax, and it's advantageous in comparison to discretionary trusts for inheritance tax as well. And then we've got life interest trusts, and these are very common for us to be drafting here at Harrington Carmichael. These are, as we've alluded to previously, drafted where clients are in blended families, concerned about care fees, or just wanting to ensure that their children benefit if their surviving spouse goes on to get remarried as well in the future. So how this works is that usually the couple will put their house into the trust. You can put more assets in, such as your money or other assets, but you need to be careful and satisfied that the surviving spouse will be able to comfortably survive on the capital that they have in their own sole name and not receiving it directly after the first spouse's death. The reason being is that when this trust gets set up, that amount that they put into the trust goes into the trust, and the life tenant, who is the surviving spouse, is only entitled to enjoy the benefit of the physical asset or the income that the trust may produce. So for an example, where they've left a house, they'll be able to live in the property. If they then need to go into care, or if they downsize and there's excess capital in cash, that money would be invested and they would be entitled to receive the income from it for the rest of their life. But you can have a power in the trust to appoint capital out to the life tenant during their lifetime, but clients should be wary that this would reduce the pot available for children later on. Any income that gets paid out of the trust can be mandated directly to the life tenant and be taxed at their marginal rate. And for married couples, it's inheritance tax neutral. So it's not a trust that's going to save on inheritance tax, but it won't have any adverse consequences. And it's really useful for just ring fencing assets, to add more flexibility and to just protect everything for the future generation, such as for care fees and stuff like that.
So on to the sort of the last one that we're going to go through, which is the discretionary trust will. This is the most flexible type of will you can really do. You could do a will that kind of blends a life interest with a discretionary trust. You might have a life interest first death and then a discretionary trust second death. But for many, they either just create a discretionary trust if they're a single person, or if they're a couple, they'll often do it on second death, particularly if they're married. So what is a discretionary trust? Well, what happens is once the estate is all finalised, everything's been paid, and you've got your final pot of money or assets, they would all go into the discretionary trust, and then you would have in your will trustees appointed to deal with those assets. You would pick trustees, of course, that you trust, and then you'd also have within your will a list of different discretionary beneficiaries. So quite commonly, people will have like children, grandchildren, and remoter issues. That means future, so great grandchildren and so forth. You may have other family members like nieces, nephews, charities, friends. It's up to you who you would put in there. But the point is they are discretionary beneficiaries, which means it's down to the trustees to decide who from that class of beneficiaries inherits from that trust, that pot of assets. So no one is actually entitled to anything from that trust until the trustees make the decision to actually appoint it out to them. Now, it's not down to just the trustees to actually decide everything. What happens is when you make a discretionary trust will, is we would prepare for you, based on your instructions, a letter of wishes. And within that letter of wishes, you would set out clearly to your trustees what you would like to happen when you pass away. So in there, as I kind of briefly mentioned earlier, you could say, you know, I'd prefer my children don't inherit any large sums of money, but you might say when they're 21, they can have £100,000. But by the time they're 30, I would like everything distributed out. Or you may say, I want the trust to be run for the longer term to provide for future generations. But it's really flexible. The letter of wishes is really tailored to the individual client's circumstances. The good thing with the letter of wishes is although it is not binding on the trustees, it should be followed, but it can be updated and amended at any point without having to actually amend the will itself. So that is really good from, you know, for somebody whose circumstances might change going forward. Perhaps, you know, you don't have grandchildren now, but then you have them in the future and you want them included and you want them left a fixed sum of money from that trust. So it's really good. Also, if the trust itself is wound up within 2 years of the date you die, then it's read back into the will. What that means is that it's as though that discretionary trust never existed. And say the decision was to appoint out everything equally between two children, then it would be as though that discretionary trust was never in the will, and that an appointment direct to those two children was within the will itself. And there's no tax consequences of doing that. If the trust is run in the longer term, then you need to be aware that the trust itself is taxed at a higher rate. So any income received within the trust is taxed at higher rates of income tax, although it is possible to claim back some of that higher rate tax if the income is distributed to non-taxpayers or lower rate taxpayers. From an inheritance tax perspective, although I'm not going to go into any detail here, but you need to be aware that to the extent the trust exceeds £325,000, that you have to file every 10 years. So it's called a 10-year anniversary charge. And there may also be exit charges when capital leaves the trust, but it's at a much lower rate than the 40% inheritance tax percentage you have on death. And sometimes it's worth paying that for that flexibility that it offers. And as Alex said, with the life interest trust, again, with this type of trust, it's really good for blended families, or as I say, if you don't want children inheriting a large sum of money, or if somebody's going through a divorce, you could hold the assets within the trust until the divorce is finalised and then distribute them out. And yeah, it's really good for asset protection. Here on this slide, we've just put an example of a typical kind of client scenario that we might see every day in our job. So we've got Mr. and Mrs. Cooper. They've been married for 15 years. They have 2 children who are minor beneficiaries, but they're very wealthy. You know, they're worth £10 million. They are mindful that they don't want their children to inherit a large amount of money too young because they think that will hinder them in the long term. But they also would like to provide for future generations, although they don't know what that will look like at the moment. So in this scenario, we would probably advise Mr. and Mrs. Cooper on second death to create a discretionary trust and then put in place a detailed letter of wishes explaining what their thoughts are, so that the trustees have some guidance how to distribute from that trust. Obviously, as I said before, it's important to choose trustees that you trust, so that you can be sure they'll follow your letter of wishes, and they should do unless there's good reason not to. And in that letter of wishes, they might well say that they want a lump sum to go out to them when they're 25, and then the rest to go at a later point, or they'd be happy for funds to be released for buying a car, for setting up a business, buying their first home, whatever it might be. It's completely flexible. But yes, it will give the ability for the children to receive funds in proportions rather than receiving everything outright, which is what their concern is in this scenario. We're going to skip through number 2, which is similar because of time, but Alex is going to talk about example 3.
Yep, so here's another example. We've got Mr. and Mrs. Dean, who have been married for 2 years. They've both been married before and have grown-up children from their previous marriages. They want to protect one another, but at the same time want to ensure that their own individual children inherit on the second death. So here is a typical example of the blended families that we've been talking about. So a life interest trust would be ideal for these clients, and it would enable the survivor to live in the property, have the income if the property is sold for whatever reason, for the rest of their life, and on their individual death, their share of the property or assets will pass to their own respective children. As I said before, these trusts are inheritance tax neutral, so you still get the spouse exemption on the first death, and on the second death, it's all accumulated as though this surviving spouse owned it for inheritance tax, but you have all the necessary transferable allowances still available, so you'll pay the same amount of tax, if any at all, as you would have done before.
And then here we've just put together a slide called Trust in Lifetime. So most of the trusts we've already spoken about can also be created in lifetime. The only ones you can't are the 18 to 25 and the Bereaved Minors Trust. So we commonly create trusts for individuals in their lifetimes. We create Bear Trusts, Vulnerable Persons Trusts, Interest in Possession, which is the same really as a life interest trust. It's just called a slightly different thing during their lifetime, and then discretionary trusts. And as we said in one of the earlier slides, the main reason people create trusts during their lifetime is for tax planning purposes, because they want to reduce down the value of their estate. They don't want to gift outright to beneficiaries, or for asset protection purposes if they're concerned, for example, about care fees.
So we've got an example here of a vulnerable persons trust. So Mr. Bello has a disabled son called Eric. He has a disability living allowance as well as other benefits. Mr. Bello has a large estate and wants to do some tax planning whilst he is alive, as well as to reduce his inheritance tax liability, but is concerned that if he gives to Eric outright, it will affect some of his benefits. He wants to know his options. So as I said, this a vulnerable person trust would be a good fit here. They can elect to be taxed as a vulnerable persons trust, and that can protect Eric's assets if we can drip feed money into him that doesn't exceed his threshold. The capital can be distributed to him as and when the trustees see fit, as guided by a detailed letter of wishes. And this would also be treated as a potentially exempt transfer for inheritance tax purposes rather than a chargeable transfer. And here's another example of a discretionary trust. Mr. White has 2 twin granddaughters, Alicia and Anna, who are currently 11. He wants to gift them for money for when they turn 18, but wants to do this now for tax planning and wants to know his options. He doesn't want to do anything too complicated. So he could create a discretionary trust here, but a Bear Trust is likely to be the better option. If we do that, then the grandchildren will be absolutely entitled at the age of 18, but before that, they can have capital advance to them for education, such as driving lessons when they turn 17, and they can benefit before they turn 18. This trust is not particularly complex to deal with. We would just need to register it with the Trust Registration Service, which is now a legal requirement, but doesn't have any complicated taxation. And again, like the Vulnerable Persons Trust, it would be considered a potentially exempt transfer for inheritance tax purposes.
Yeah, and just a final point on the Trust Registration Service, as Alex said, with all of these trusts, there is now a requirement to register them with HMRC's Trust Registration Service. There's a few trusts which are exempt from registration, but majority, certainly the ones we've spoken about today, do need to be registered. It's not complex, it's something that you do online, but it is a requirement that now needs to be adhered to. As we said, we haven't gone through the kind of inheritance tax consequences of creating these trusts or the taxation in any great detail, just because of the time today. But if anyone does have any further questions in relation to trusts, please do ask any questions you have now. Anybody want to ask anything? Feel free to ask on this webinar. If no one's got any questions, I mean, feel free to contact either Alex or myself after the webinar. We've got our contact details here on the page, which you can see, or you can scan the QR code and get our details. More than happy to have a conversation with anybody watching about trusts, or if you've got any other queries about wills or anything else private client related. Thank you so much for listening.
Thank you.
Have a good rest of the day. Thank you.